India Bonds presents CNBC TV 18, India's Fixed Income Summit.
You know, I must say that somebody outside said, well, you know, we're all equity chaps moderating bond panels today, except, of course, our own very Lata. But you know, the enthusiasm that I heard from, I think, Aditi earlier, Vishal, and, of course, our own Lata, is just infectious. I mean, you want to go out and buy a bond. But I think it's my honor to be here. And, of course, it's an esteemed panel. So let's kick this off. I mean, I think the question we're asking is where we are in the credit cycle. So let me just put that exact question to our panelists one by one. And why don't you kick this off, Krishnan? Where are we? Are we in the early stages? Are we in the mid-cycle? Are we in the late stage caution cycle? Where are we?
Yeah, thank you so much, Prashant. Very good evening, everyone. Pleasure to be here. When we talk of credit cycle, being from a credit rating agency, the way I look at credit cycle is what is the status of the credit quality landscape or credit conditions. So it could be benign, it could be risky, and so on and so forth. So today, the way I look at it is we are in a benign credit quality environment. And if I look at, say, corporates or even financial sector entities, balance sheets have improved over time. So if I look at CRISIL's rated universe, which we rate around 7,300 active companies, and if you look at, say, the leverage levels, the median gearing has halved over the last decade, come down from 1.1x to 0.5x. Interest cover ratios have more than around double, 2.7x to 5.2x. And if I look at financial sector entities, again, asset quality has improved, provisioning cover has improved, companies have a lot of cash on their balance sheet. So overall, we are in a I would say, benign credit quality environment, but we need to keep at the back of the mind that long-termism has to be key in our approach or assessment and analysis, because we need not be lulled by the fact that the last few years we've not seen too many defaults. But if I look at a 10-year horizon, we did see some defaults, large-scale, high-profile defaults actually, which actually paralyzed the market to some extent for some period. Today, we should not forget those. Credit cycles come up and down. Credit quality can deteriorate, and we need to keep that at the back of the mind. Robust credit assessment is the need of the hour. But today, as I said, I think we are in a benign credit environment.
Benign credit environment. Suyash, you want to sort of jump in there? Your assessment?
So, Prashant, I would agree. And there are 3 or 4 highlights or aspects that, I'd want to point out. First is, I think it's becoming very much more sector specific, because given the context of the war and, so there's multiple shocks that the system is facing over a period of time. The other thing is, over the last few years, you have had a very large retail leverage cycle, but the starting point was very large or healthy amounts of capitalization. So clearly, you're not seeing much there. And you also had, corporates starting with very benign balance sheets, and you haven't had much of a capex cycle, which would draw that, kind of resourcing out. But I would say, where we are now, and, not really from a credit deterioration standpoint, but the right pricing of credit, we are in essence in the midst of a funding shock, which is coming from a sustained period of balance of payment deficit. And, so the country level lack of dollar funding is percolating into liability side, funding, I would say, stresses in terms of availability and cost of capital across the board. And on the other side, you are seeing probably a once in a decadal, if not more shock from, the commodity cycle suddenly flaring up, the lack of the India-US deal probably pressuring the SME, MSME sector. So not so much of the credits that we as mutual funds get exposed to, because, most of what we are talking about may not be issuers in the market. But I was just caution, that things are different for different people now, and there is a generalized, need to right price. Because if you're the holder of capital, you are, basically the setter of the narrative right now. Because in essence, what we are facing is a bit of a paucity of capital.
When you say a bit of a funding shock on the liabilities side, Is the chase for liabilities was there even before, or this is something which has happened now because of what's going on?
So, used to be a...
because I thought liquidity was ample. Or that's not the case. Or you're saying it's ample for some, but not for many others.
So where we would distinguish is, the availability of what we called liquidity under the liquidity adjustment facility of the RBI, which you measure as net repo, reverse repo, and the actual presence of enough liability side on balance sheets. So basically, despite 4 lakh, 5 lakh crores of surplus liquidity in LAF levels, what we all understand is banks don't create or destroy liquidity, neither do corporates create or destroy liquidity. So what is lacking at this juncture is probably, and this is a 2-year-old problem now, that the BOP level stress is, giving rise to what is otherwise known as the impossible trilemma, which is that, if your external account is under pressure, that shows under rupee pressure, and that goes against the independence of monetary policy. So what you're seeing is the 5-quarter repo rate is basically irrelevant for the market. And therefore that fundamental anchor of where rates should be versus the repo rate for the time being is lost. So I'm coming not so much from, that there is large scale credit stress building, which clearly it doesn't seem to be. I'm just coming from standpoint of right pricing of all spread across the curve, because still, this BOP stress is with us. Probably the funding stress is also with us.
Fair enough. And we'll come back to some of the macro points in just a bit. But Kruti, you want to sort of address that? Just a quick assessment.
So, like rightly pointed out by both of them, but also I would like to go back to the few panel discussions that have been there before this, right? It's a matter of trust. And we've seen that come back in the bond market after a long time. Bond markets have gone through 2013. They've gone to the other NBFC crisis. But every time that we have come into the market, we've come back with stronger regulations, stronger systems. And not only in India, anywhere the function of a market liquidity or function of market building up is the function of regulations, which is why we see more active markets in some regions and we don't see active markets in some region. So we've seen worst of it in 2022, we've seen worst of it in 2013. We have certain things in place where regulations have also come in place, and at the same time the government support has also come at right time. We see that announcements happening. So yes, there is a stress, there is economic stress that we see because of balance of payments. Obviously, we see other credit to deposit ratio has also widened a lot. But given that the systems are in place and we are now, before we used to be more reactive, now we've become more proactive when it comes to regulations also or any measurement that has to be taken. Therefore, this feels that we will go through this cycle smoothly, rather than there obviously will be pockets of it, because ultimately credit cycle is a function of what derives from the economic measures, right? So how long this situation goes on, obviously it will be a derivation of it, but if it is something that we can contain it or it is short-lived, then we will see that we will flow through this cycle very smoothly.
Fair enough. I think for about 2 years, credit growth was a little lower, then it started picking up towards the end of last year. All the way into February, it was looking fantastic. And then, of course, late February, this entire thing started, and credit growth, etc., has taken a bit of a hit. Amit, your first thoughts on that exact question, which is where are we in the cycle?
Yeah, I think the best of balance sheets improvements are behind us, which does not mean that balance sheets are looking bad right now, but incremental improvements are very difficult to come by from here on. The second is, if you just segregate corporate credit and retail credit, on the retail credit side, cash in the consumer hands is slightly better right now in the last 6-8 months. That's what you refer to when you talked about the consumption cycle. But there is a K-shaped element to that, so we have to be careful on that side. There are parts which are doing very well, there are parts which are not. The last point, I think Suyash and everyone has already spoken. I think I would agree with Suyash's point. While the balance sheets are good, we are today as an economy struggling to fund 13% credit growth, which means that somewhere the market infrastructure is becoming an issue. This is a macro structure issue. And the second macro structure issue which we need to address is this complete breakdown in terms of transmission, at least as far as debt capital markets are concerned, vis-a-vis the policy rates. I can amplify Suyash's point by telling you that today banks are borrowing 3-month money at 225 basis points over repo. The last time that happened was in a crisis period. So somewhere I think we need to manage the macro level issues properly at this point in time so as to ensure that the liquidity issue does not convert into a credit issue in the near term.
When you said that we are struggling to fund a 13% credit growth overall, I mean, just is it because of some of these rate distortions across the curve? Is that the issue here?
No. So very frankly, I think banks are possibly the only large providers of credit in this at this point in time because of various structural issues. Debt capital markets have still not reached a point where you can use them as a fallback mechanism for availing credit at all points in time. We are at best seasonal fair weather friends in most of the times. In any kind of a macro stress which we are going through right now, the moment you see liquidity getting uneven across the ecosystem, wherever you see some amount of friction in terms of liquidity, which is essentially the friction flowing out of the BOP issue, you are suddenly seeing banks struggling to fund a credit growth which is actually much lower than what we were used to funding in the last 10 to 12 years. So it is essentially a market, I don't know how to put it, a market infrastructure or macro market level issue that we are facing right now.
Okay, so I thought I'll start with corporate bond infrastructure, spreads and all of that question, but I think Suyash and Amit both have raised the question of the macro level stress, if I can put it like that, which needs to be solved. So let's jump straight to that. I mean, it's a I don't want to use the word crisis type situation, but it's been a stressful situation. Maybe things are, things have come up a little bit from extremely stressed levels over the last maybe 76 hours, maybe a little more. Suyash, but what needs to be done, in your opinion? I mean, what's the repo is at whatever, 5 or the 10-year is at 7. As Amit said, you're borrowing 3-month money at 200 plus basis points over the repo rate. Are we looking at what are we looking at? I mean, 5th of June is the policy from the Reserve Bank. What should we expect?
So Prashant, used to be a time not so long back, in fact, most of our careers, what we used to track as the fundamental point to be bullish or bearish fixed income was the status of country's current account deficit, right? And actually, somewhere in 23-24, we became extremely bullish on interest rates because we saw what we thought was almost a structural compression of a current account deficit, courtesy the services trade balance moving from a 5 billion surplus per month to 15 billion surplus per month, largely owing to the GCC phenomenon. And that looked sustainable to us. However, the last 1.5-2 years is not about current account, but the funding of what is even a modest current account. And to us, the starkest measure there is what is known as basic balance, which is net FDI plus current account deficit. So that tells you the sustainable level of current account that the country can run. And the basic balance has actually been negative for almost 2 years. So then we started to hunt for reasons as to what could be changing, because certainly nothing much was changing for us. Our inflation credibility is fine, fiscal credibility is fine, growth matrices have been okay. So something has changed for the world. And there are 3 things that we can distinctly figure out that has changed in the world. The first, and I think it's very, very underappreciated, although we talk about it, is that the average level of global rates has set up. So, in the post-COVID, post-Russia-Ukraine inflation shock, we used to say that, Fed has hiked, US rates have gone to 4 to 5%, but they won't sustain there because those economies are not built to handle these rates. But guess what? They are thriving in those rates, right? So, if you are any sort of a global asset allocator, the risk-free rate that you now have to beat is higher. And that may not be showing as, debt flows, but certainly banking flows, challenge in ECB raising, etc. So, the capital account is reasonably fungible. The second thing that has turned is now you have competing themes for capital allocation around the world that are very powerful. So look at the AI theme. You're talking about $1 to $5 trillion companies, right? So it's no longer, emerging markets growing at 10%, attracting capital from the rest of the world. It is, these large, large balance sheets that are, posting 15, 20, 25% growth rate, not to mention the AI capex cycle that has started in the US. So if you're a global portfolio manager, you have high global rates and competing themes around the world. So probably 10, 12% nominal growth rate is not good enough. And the third point, which also needs to be thought about, is that the second largest economy in the world is sitting on this massive excess capacity. So how can you really have a broad-based manufacturing capex cycle anywhere else in the world, but for the themes that are topical today, right? So if you have to lift 200, 300 basis point investment to GDP, I'm not talking about specific sector, capex, but aggregate 200, 300 basis point, you could potentially argue that if not for the capex associated with AI, the narrative is just not there. So it's basically this combination of three things, and that has now been in play for last 1.5, 2 years, that is essentially leading to cheapening of your asset base. Now the problem is cheapening itself is not good enough. You need a narrative alongside the cheapening, and a sustainable turn to this can really happen only with two things: either global rates for whatever reason start to come off, or the AI theme starts to fatigue itself. You may get a temporary reprieve with the war cessation, because that is, to us, the fundamental issue with the war from just the market standpoint is not the inflation impact, not the growth impact, but the BOP impact, the balance of payment impact. See, at this juncture, I would probably, most of this panel would agree with me, nobody even cares if RBI repo rate was at 6%, right? Provided in the journey to 6%, they did not destabilize our rate hike expectation. So it should not be an intermeeting hike like what happened in the last cycle, but nothing is being priced of 5 quarter. So look at term spreads, your back end of the government bond curve is sitting at 770. The post-COVID high, when fiscal for India peaked at 9.2 and Fed funds rate peaked at 5 quarter to 5.5, the long end of the government bond curve peaked at 795. We are at 770 now. Right, so nothing is being priced off it, and to my earlier point, the term spread market is showing stress. To Amit's point, the AAA blue chip funding market is showing stress, and therefore any sort of capital allocator has to do right pricing today.
So just to finish that loop, there is of course waiting for the AI trade to fade off and oil prices to fall and the war to settle down or excess capacity to be used up. Those are external. Right now, say for example, out of Mumbai, the RBI, what should we expect? Just to close that loop off, because do you have to react in some way to what's happening right now, or wait it out?
No, I would say, given that average inflation forecasts have to invariably move up, and RBI is first and foremost an inflation targeter, they should start the rate hike cycle going, but at the same time ensure that they don't unanchor markets' rate expectations. So you don't need a fresh pressure point coming from mixed commentary from the RBI. So you start the rate hike cycle going just to continue to be credible as a conventional inflation targeter. But it won't solve much for the time being. What you could potentially hope for is a benign confluence of events. And I am not operating via perfect wisdom. I'm sure there's a big piece I'm missing here. But what we can think as a benign confluence of events is some sort of a dollar bond strategy, to whatever extent jumpstart it with a $30-40 billion flow. The cessation of war that takes commodities, so let's say oil back to 85-90. And then at some juncture, if the shock to the US economy, because that's also a K-shaped economy, starts to show in their labor market and Fed rate expectations were to turn again, then you could potentially get a window where dollar depreciates. In 2025, dollar depreciated, we didn't benefit. A lot of other EMs did. But hopefully this time around, because we are cheap enough, that could potentially show with us. And so you need that jump start to happen, and from there you can build that narrative. So
start the rate hike cycle and probably a dollar debt issuance, which brings in a chunky amount of money, and then wait for some of these other things to fall in place, hopefully. Fingers crossed. Yeah. Just to sort of, you addressed that same point, so I just want to come back to you. If you want to add something to what Suyash said, and then we'll move on to the next topic.
No, I think we can move on, because it's about regaining the status as the inflation fighting central bank. I think they need to speak that language. They don't need to spook the markets. They need to start early so that they don't overreact at some point in time. But just to add one point, I think, yes, there is a larger macro issue around BOP and liquidity impact, etc., etc. There is also internal micro issue in terms of money flowing within capital markets to various segments. I don't want to repeat what Lata has already said. You need to address that sooner or later. Believe me, there is money flowing into such segments where you get taxation benefits vis-a-vis debt markets. That is not funny any longer. You are actually curtailing flow of credit to where it is required.
Which means, sorry, just to illustrate that point.
Just to illustrate that point, everything in India other than debt.
I see. The tax issue, which is
everything under the sun is taxed differently, and not all of it is productive.
Okay, yeah, no, 100%. I mean, I think, and that's a jab at equities, maybe.
It is not. When I said everything, it includes everything that is non-debt.
Yeah.
And nothing against any other asset class. Everything needs to grow, but debt also needs to grow. I think we have created a market architecture issue now in terms of the simplest solutions also not being solved through debt. Everyone is going to everything other than debt, even to park 1 month money today. So that's the situation.
Krishnan, just to sort of come back to the where money is going, who's being able to access money, are investors sort of concentrated in what is perceived as safety in that sense? I mean, in the AAA and are other segments kind of below that found wanting for money, or you think it's kind of evenly distributed? While from the top it looks like, well, as you said, it's pretty benign, but what's happening under the surface?
I think that's a very good question. From my perspective, I see a paradox. When I talked about benign, I was talking about from a credit quality landscape, situation is benign. But at the same time, if I look at the bond markets, they are very muted. Last 6 to 9 months in terms of issuances, it's actually negative vis-a-vis similar period of the previous year. But just from a background, a more long-term picture, if we have to kind of have a very strong broad-based economic growth and a resilient financial system which supports our move towards Viksit Bharat, what we need to have is the banking system and the bond markets both complementing and competing with one another and ensuring that there is a steady stream of low-cost funding to India Inc. Now, today, if I look at, while banks are reasonably doing well on major parameters, deposit growth is an area where they are still struggling with. Today, the gap between deposit growth and credit growth is around 300 plus basis points, which is not sustainable for a longer period of time. So they are, as Amit pointed out, looking at short-term CD raising. Some of the private banks are looking at securitization. They can issue bonds and so on. But unless deposit grows in a sustainable manner, credit may not grow to a large extent. Now, coming to the bond markets in India, historically, it has been narrow. Access to bond markets have been to AAA and AA credits only. 90% of the issuances are in these segments. And we need to take a series of steps in both the supply side and the demand side to ensure that we have a more vibrant, deeper bond markets. Today, if you look at the US, the corporate bond market as a percentage of GDP is 45%. India, it's 16%. Securitization market in the US is 53% of GDP. India, it is 2% or less than 2%. So unless we grow these, for instance, securitization and covered bond from a supply side perspectives, if it has a proper policy support, it can help lower rated credits, the mid-rated credits, access the bond markets. Today, an interesting study that we did was for A-rated corporates. The risk-adjusted return for investors is actually higher than in AA and AAA rated credits. And if I look at today the balance sheet, the debt protection metrics, gearing, interest cover, etc., for A-rated credits, it is actually has improved substantially the last 10 years. Today, an A-rated company is looking more like a AA-rated company of 10 years back. So that's how it is. And in terms of universe, if I look at our universe, we have 1350 A-rated credits. AA and AAA put together is 950. So that way diversity is also there. So unless we start moving down the credit spectrum, more from a patient capital perspective, also insurance companies, pension funds, it will become difficult to broad base the bond market. Other thing, of course, tax-related disparity is there. Other thing is the retail investor base in bond markets. While marginally growing, but still it's well below what it should be. And today, some option can be a tax benefit to them in, say, infra bonds. For instance, in Brazil, last decade, there was an incentive on infra bonds, and we saw a large proportion of retail investors investing there, and that segment itself picked up. We need to figure out some way of getting retail investors into the market, have a broader bond market, and the bank loan also needs to grow. So all that needs to happen for a smooth flow of credit into the economy.
Do you think on the retail point, I mean, taxation, you'd also agree? I mean, the panel agrees taxation
yes,
is the number one issue across the board? When we're talking about, I mean, interest in, I think Amit said that, Suyash, you also agree? Taxes?
So, absolutely yes, but I would put a slightly different point as well. We would be quite happy if the taxation benefit for the time being extends to the super good quality of the bond market. See, look, first and foremost, mutual funds are a very efficient way to intermediate savings, right? So, the problem now is that even the best quality part of the bond market has very little retail participation, right? So, you have, through RBI bond platform, etc., you have some. And you could argue that, through your PF, etc., you're getting indirect participation. But, there are fairly lucrative rates sitting, relatively speaking, from an access standpoint in just the AAA and sovereign market. So, a first step could even be that that part of the market, and I'm not, so, it's just one starting point. I'm not saying that's the end point. Just that part of the market has some kind of a tax incentive if, if something else is coming in the way. So let's say, a mutual fund or any kind of a savings product, which only has, let's say, sovereign or public sector AAA exposure, and even, let's say, caps the total, manufacturing charges that they're going to put, even put those parameters in place and, give the taxation benefit so that just, the depth of retail savings. So when we talk about development of the bond market, it's always the lower rated issuers. But frankly, today, can I liquidate 1,000 crores of a PSU AAA in the secondary market? The answer is no, right? I cannot. So none of the large institutional investors like your, large insurance and provident funds are in the secondary market. And all of us mutual funds may be institutional investors, but our funds flow all happen in the same direction. So we are all selling or we are all buying. So how do you create, first and foremost, depth in the sovereign and AAA? So look at the sovereign market. There are 2 or 3 benchmark securities that garner all the volume, right? If you want to, let's say, create a 7-year sovereign portfolio, you can create it, but can you trade it on a day-to-day basis? No. So I think, I would actually encourage a shift in conversation a bit to first, provide diversification and liquidity to the best part of the market and then move down from there. And, that is how tranching will happen more efficiently without force fitting. So as an example, for a mutual fund, liquidity is paramount. So we may arrive at a situation where open-ended mutual funds have strict limits on how much of lower rated credit you could buy, but at the same time you could create structures, with liquidity gating that does that. Or you may find that banks are best, poised to service the AA minus and below part of the market and keep AA and AAA, more to the institutional market-facing players. So I think it's time that, we have some of those conversations with respect to the quality part of the market as well.
I don't know if the SEBI representative is here, but some excellent suggestions. But so you put it, the clock is up, but just a quick 10-second responses. I mean, say this entire Iran issue and oil settles and it cools off a little bit. What are the 1 or 2 things you'd watch as you look ahead in the next 12 to 18 months with regards to the credit cycle? I mean, what are going to be the sort of markers? How would you assess how strong or how weak this cycle is going to be from here, Suyash?
So first and foremost, the re-anchoring of market rates to RBI policy rate. From there, reasonable volatility to credit spread pricing. So today, you are in an environment where the non-SLR curve moves by 50-60 basis points over 3 or 4 weeks. And then, take it from there. Like I said, and I think like Krishnan and Amit also said, it's a very disparate credit market right now. So there are parts of it where you have had 20% CAGR growth rate for 5 years. There are parts of it where there is excess capital, etc. So that part you can basically figure out bottoms up.
Krishnan?
I think two things. I would say interest rates and interest spreads stabilizing or coming down, and investors starting to move down the credit spectrum. These two are important for stability to come. Because the other thing that why I'm saying that is because today AAA corporate is also going to the banks to borrow rather than from the capital markets, because he's getting finer rates there. So there needs to have some semblance of stability.
Kruti?
Credit to deposit ratio, as we are already watching, and how the NBFC spreads are moving, because NBFC is the key pillar where your small industries get financed, and if there the stress is coming, then probably it's a wake-up call. So credit to deposit ratio.
Amit? Sorry, I'm coming to you last, so others have spoken.
That's okay. Then a slightly different take on this. I think we should just work on allowing the markets absorb this risk. So let's just work on the infrastructure part. I would think that we should make sure, Manindra madam also mentioned about it, we should make sure 18 months down the line, if any investor has the risk appetite, he should not be unable to buy a bond just because of lack of capital. So just make the repo markets work. Believe me, it
Which
has
is you should
worked
be able to repo corporate bonds, basically.
You have to allow people to borrow against in a repo market, which should be liquid, available to everyone. Risk appetite is very different from balance sheets. Just to extend Suyash's point for 1 second, it does not matter if the EPFO does not buy AA bonds or single A rated bonds. If I have the risk appetite, unfortunately, I don't have the capital and he has the capital, right? So you only need to move capital from people who have money to people who have risk appetite. Repo is the only way to do it. Just do it properly and the markets will become much more liquid. We'll be able to handle some of these stresses much more easily.
I think excellent suggestions, excellent conversation. Amit, Kruti, Krishnan and Suyash, thank you very much, all of you, for being here. Thanks very much for being a wonderful audience. Thank you.
India Bonds presents CNBC TV 18, India's Fixed Income Summit.